All right, so today we are going deep
Yeah.
into Humphrey Yang's 10 crucial personal finance lessons that transformed my life from his
Yeah.
YouTube channel.
Okay.
And
This will be good.
it's a really good one. He has so much wisdom packed into it.
I think people are really going to benefit from this.
Yeah, and personal finance can feel so overwhelming, so we're going to help you extract the most actionable and intriguing parts so you can really level up your own financial game.
Yeah, I like how he really digs into the psychology behind money habits.
Yeah.
It's not just about
Yeah.
telling you what to do. It's about understanding why we do the things we do with money.
Right.
And he has this great phrase, if you can't buy it twice, don't buy it. Like, how good is that to fight impulse spending?
Oh, I love that. Have you ever made a purchase that you regretted later?
Oh, all the time.
Right.
Especially online shopping. That gets me.
Yes. Oh my
Yeah.
gosh, me too. 2-day shipping will get you every time.
Every time.
But that rule, I think, is so smart because it makes you really pause and consider, is this actually worth it?
Yeah, do I really need this or do I just want it in the moment?
Exactly.
And I like that he connects that to investing too, that same delayed gratification mindset.
Yes.
Because, in investing, patience really leads to those greater long-term gains.
Absolutely. And he talks about a time when he almost switched jobs for a bigger paycheck,
Right.
but then realized that long term, it wasn't actually the right move for him.
It's so easy to get caught up in that short-term thinking.
Yeah.
Ooh, more money. But sometimes you got to take a step back
Right. Exactly.
and think about what really aligns with your goals.
Totally. And he actually highlights these 3 numbers that everyone should be tracking for long-term success: expenses, savings rate, and net worth. It's your financial dashboard.
It's like your financial scoreboard. Are you winning or are you losing?
It's so true, and it can feel really confusing, where do I even begin? But if you can just focus on those 3 key things, it really helps to have some clarity.
And it's not as complicated as people think.
No.
I think sometimes people get really intimidated by all these fancy financial terms,
Right.
but it can be pretty simple.
Yeah, and so he suggests aiming for a 10% savings rate, which sounds like a lot to some people, but even if you just start small,
And gradually increase it over time.
exactly, that's what's important, that consistency.
Yeah, little by little, it all adds up.
And what I thought was really interesting is that he highlights this calculator from the 4-Pillar Freedom blog,
Okay.
and it shows that even with decent investment returns,
Yeah,
the majority of your wealth in those early years comes from just consistent saving.
right. Not necessarily just the magical market returns.
Yeah, it's a good reminder that it takes time.
Patience. Patience is key.
It really is. And this reminds me of another point that he makes about simplifying your investments.
Oh, yeah.
He talks about people having portfolios that are overflowing with ETFs,
Right, 100 different ETFs.
and they often have overlapping holdings.
It's having a closet full of clothes,
Yeah.
but you never wear half of them.
Yes.
Just clutter.
Exactly. It just seems complicated for no reason.
Yeah, and he makes the point that a simple S&P 500 ETF
Okay.
has actually outperformed 92% of professional fund managers
Yeah.
over a 15-year period.
Wow.
That's pretty crazy to think about.
It is. I feel like we overcomplicate things when in reality, just keeping it simple is better.
And then we stress about it more too.
Yeah.
So keeping it simple, it's good for your mental health and your financial health.
Exactly. And speaking of simplifying things, he also talks about avoiding depreciating assets.
Yes.
So these are things that lose value over time.
Obviously, we all know cars.
Yeah, cars are the classic example.
He also talks about other things like
No.
jewelry,
Oh,
clothes, and furniture.
especially trendy furniture.
Yeah, something that's oh, this is in, and then next year it's out.
Right.
So what are your thoughts on that? How do we avoid falling into that trap?
Yeah, I think it's so easy to get caught up in the excitement of buying something new.
Yeah, that dopamine rush.
Right, but we don't always think about the long-term financial consequences.
And especially if you're borrowing money to buy these depreciating assets,
Yeah.
that's when it really gets dangerous.
Yeah, because you're paying to lose money, essentially.
You're paying interest on something that's going down in value.
It's like a double whammy.
Exactly. Ouch.
Yeah, so it really makes you think twice before you pull out the credit card.
Absolutely. Think before you swipe.
So true, and this all ties back to his emphasis on long-term thinking.
Right. Being patient.
And he has some really fascinating analysis from this blog called Of Dollars and Data by Nick McGilly.
I love that blog.
It's so good. And they delve into this concept of the PE ratio.
Okay. Yeah. Price to earnings ratio.
Right. So for our listeners who might not be familiar with this, could you explain what that is?
Yeah. So basically the PE ratio, measures a company's stock price
Okay.
relative to its earnings. So it's going to give you a sense of how expensive the stock is.
Okay.
So let's say a company has a stock price of $100 per share,
Uh-huh.
and it earns $10 per share annually. So its PE ratio would be 10.
Okay.
So that means that investors are paying $10 for every $1 of earnings that that company generates.
Got it.
Now, generally, a higher PE ratio suggests that a company's stock is more expensive
Okay.
relative to its earnings, while a lower PE ratio indicates that it might be undervalued.
Interesting. So it's not just about buying any stock, it's about understanding like how expensive it is.
Exactly. And what's interesting is that McGillie's research shows that as the PE ratio increases,
Okay.
meaning that stocks are getting more expensive, future returns tend to decrease.
That makes sense.
Right.
Yeah.
If you're buying something at a premium, you can't expect it to appreciate as much as something that you bought at a bargain.
Right. Right.
But here's the key takeaway.
Okay.
Regardless of the PE ratio at the time of investment, holding investments for 20 years or more significantly reduces the chance of negative returns.
That is reassuring,
It is.
especially for those who might be a little intimidated by the market going up and down.
Yeah, you ride out those waves.
Yeah, and Yang actually uses the example of 2012 when a lot of people thought the market was overvalued
Right.
and they missed out on huge gains over the following decade.
Yeah. FOMO is real in the stock market.
It really is. So it's just that reminder of don't let fear kind of dictate your decisions.
Yeah, because that fear can make you miss out on those opportunities.
Totally. And speaking of fear, his next lesson is all about the comparison game.
Ooh, this is a big one.
It's a huge one, especially in the age of social media.
Everyone's showing their highlight reel.
It's so true. It's so easy to get caught in that trap of comparing our financial situation to others.
And feeling inadequate.
Yeah, like we're not doing it.
Yeah, like we're behind.
Right, but what I love about his approach is that he encourages us to really tune out the noise and focus on our own unique paths.
Because comparison really is the thief of joy.
Yes, so true.
And he emphasizes that you never know what's going on behind the scenes in other people's lives.
Right.
They might be drowning in debt.
Right.
They might be struggling in ways that you can't see.
Yeah, you just never know the full picture.
Exactly. So comparing yourself to others is just a recipe for dissatisfaction, and it can lead to poor financial decisions.
So true. And this actually leads us perfectly into his next lesson, which is his concept of the 30K millionaire.
Ooh, I love this one.
It's so good, and he gives these really funny examples.
The BMW driver who still lives with his parents.
Yes.
The VIP table with no drinks.
Classic examples of people spending beyond their means to project this image of wealth.
That's like a facade.
Yeah, it's a financial facade.
And this actually connects back to the findings in The Millionaire Next Door,
Yes.
which revealed that most truly wealthy people
Yeah.
live surprisingly frugal lifestyles.
It's true. So what are your thoughts on this? Like, do you think there's a connection between our desire to keep up appearances and the rise of social media?
Oh, absolutely.
Right.
Social media has definitely amplified that pressure to keep up with the Joneses.
Totally.
It's like everyone's trying to outdo each other with their latest purchases.
And their vacations.
Yes, they're perfect lives.
It's a highlight reel.
Exactly. But The Millionaire Next Door challenges this notion. It highlights the fact that true wealth often comes from living below your means
Right.
and investing wisely, not from flashy displays of consumption.
It's about building a solid foundation.
Exactly. It's not about trying to impress others. It's about creating a life of financial security and freedom for yourself.
So well said. And this leads perfectly into Yang's final point for this section of the deep dive.
Okay.
He emphasizes that your risk tolerance is unique.
Yeah, this is so important.
It is. And just because a financial decision worked for someone else, it doesn't mean it's the right fit for you.
Everyone's different.
Right. Everyone has different circumstances, different goals, different conscience levels.
Different levels of knowledge, too.
Yeah, and he actually encourages viewers to think critically about any advice they receive, even from this deep dive.
I love that he says that.
I know, it's so important.
Yeah, because, there's no one-size-fits-all solution in personal finance.
Exactly. It's about taking ownership
Right.
and filtering it through your own circumstances and risk tolerance.
And he really encourages you to just be curious.
Yeah.
Ask questions.
Yeah.
Do your own research. And, never stop learning.
It's a continuous journey.
Absolutely. And speaking of aligning with your values, Yang's next point tackles a topic that's deeply personal and can have a huge impact on our spending habits. the comparison game.
Yeah, it's so easy, right, to fall into that trap of like
Yeah.
comparing ourselves, especially like you said, social media, everyone's showing their highlight reel, and it's easy to forget that.
It's like, are we comparing our chapter 1 to their chapter 20?
It's so true.
We don't know what's going on behind the scenes.
Right.
It's so easy to look at someone and think, oh, wow, they've got it all figured out. But, like, you never really know.
Never. And this ties back to his point about avoiding that, 30K millionaire
Right, yeah, those outward appearances.
syndrome. Yeah.
It's so easy to get caught up in that, especially, I think, when you're younger.
Yes.
There's that pressure to, like,
Keep up.
keep up with everyone else. But, as we talked about,
Yeah.
true wealth is about building that solid foundation.
It's not about putting on a show.
Exactly. It's not about the flashy car or the designer clothes.
Right.
It's about, having your finances in order so you can actually live a life of freedom and security.
Yes. And he tells this funny anecdote from his podcast with Morgan Housel.
Oh, yeah. I love Morgan House.
He's great.
He's got so much wisdom
Yeah.
to share about money.
Yes.
And I think he jokes that the best investors are often the ones who have forgotten their account passwords.
Because they're not constantly checking it and getting swayed by the ups and downs.
Exactly. They're not like,
Stressing.
emotionally attached to every little fluctuation in the market.
Right.
And it just shows the power of what Yang calls boring investing.
Such a good term for it.
It's not sexy, it's not exciting, but it works.
It's so true.
And he's a big advocate for dollar cost averaging, which means you're just consistently investing a set amount of money at regular intervals.
Okay.
So you're not trying to time the market. You're not trying to pick the perfect stock.
Right. Just stay consistent.
You're just consistently putting money in no matter what's happening. And it takes the emotion out of it.
Yeah, because that's so hard when you're seeing those big swings to not react emotionally.
Right. Our brains are wired to run away from danger.
Yeah.
And when the market's going down, it feels like danger. But if you're just consistently investing,
Yeah.
you're actually taking advantage of those dips.
Yes. You're buying on sale.
Exactly. And Housel actually, he advises to aim for average returns over an above average time period.
So you're not trying to hit it big.
Yeah, you're not trying to be like the next Warren Buffett.
Right.
You're just trying to be consistent and let time do its thing.
And that can actually put you in the top 5% of all investors.
It's amazing.
It's I feel like we have this idea in our heads that you have to be like this financial wizard to be good at investing, but it's really just about those simple habits.
And it goes back to that delayed gratification. Where
Yes.
It's about playing the long game, building that wealth slow and steady, not trying to get rich quick.
Right, exactly. And it's so interesting how he connects all these seemingly disparate concepts together, like
Yeah.
the delayed gratification, the boring investing, the tuning out the comparison game.
It's all connected.
They all point back to the importance of focusing on what truly matters, your long-term goals.
Yeah, it's about building that financial fortress,
Yeah.
brick by brick,
I love that, like a strong foundation of saving,
Yes.
protective layers of smart investing, and a mindset that prioritizes security and freedom.
Exactly. It's not about keeping up with the Joneses. It's about creating a life that you love.
So true. And so if we were to distill Yang's wisdom down into a few key takeaways for our listener,
Okay.
what would you say are the most important points to remember?
I think the biggest thing is that building wealth isn't about following a rigid set of rules.
Okay.
It's about understanding the principles behind sound financial decision-making
Right.
and then adapting them to your unique circumstances.
Yes.
Developing habits that support your long-term goals.
Okay.
So Yang provides a great framework, a great starting point.
Okay.
But ultimately, it's up to each individual to take ownership of their journey.
I love that it's not about here's the exact formula. It's more about here are the tools. Now go figure out how to use them in your own life.
Exactly. Find what works for you. There's no one-size-fits-all solution.
So as we kind of wrap up our deep dive into Humphrey Yang's 10 crucial personal finance lessons, I'd love to hear from you, the listener. What resonated most with you? Was there a particular lesson that really hit home on a personal level?
Yeah. And what's one small step that you can take today
Yes.
to put these lessons into action?
Right, because even the smallest actions can create a ripple effect over time.
Absolutely.
So maybe it's finally setting up that budget you've been putting off.
Yeah.
Or automating your savings contributions.
Or maybe it's just committing to learning more about investing.
Yes. Whatever it is, take that first step and just keep moving forward.
Yeah. Your future self will thank you.
So true. Remember, financial well-being is a journey, not a destination.
And speaking of journeys, Yang's final point encourages us to embrace the individuality of our own financial paths.
Yeah.
He emphasizes that your risk tolerance is unique, and what feels comfortable for one person
Uh-huh.
might be incredibly stressful for another.
So true.
It's about acknowledging that there's no right or wrong answer when it comes to risk.
Okay.
It's about understanding your own comfort level, your financial goals, and making decisions that align with your values.
He actually challenges viewers to question any financial advice they receive,
Oh, yeah.
even from trusted sources.
Even from us.
I know.
Even from Humphrey Yang.
Exactly. And to filter it through their own unique circumstances.
It's a call to take ownership of your financial decisions.
Right.
And not blindly follow the crowd, because what might be a great investment for someone else could be completely wrong for you.
So how can our listener determine their own risk tolerance?
That's a great question.
Like, what are some questions they can ask themselves?
Well, I think it starts with understanding your financial goals,
Okay.
both short-term and long-term.
Uh-huh.
What are you saving for?
Yeah.
Is it a down payment on a house? Is it retirement? Early financial independence?
Yeah.
Once you have clarity on those goals, then you can start to assess how much risk you're comfortable taking to achieve them.
So someone's goal is to buy a house in the next 5 years.
Right.
They might be more risk averse
Yeah.
because they need that money to be relatively stable.
Exactly. They need it soon, and they need to know it's going to be there.
But someone saving for retirement decades from now
Right.
might be more comfortable with higher risk investments because they have more time to recover from potential losses.
Yeah, that time horizon plays a huge role in risk tolerance.
Makes sense?
Another factor is your emotional response to market fluctuations.
Okay.
Some people can stomach big swings in their portfolio
Yeah.
without batting an eye, and others, experience a lot of anxiety and stress.
Right.
So it's about being honest with yourself, like, how would you react in a market downturn?
Yeah. If you're the type to panic sell everything when things get rough.
Yeah, you might need to adjust your risk tolerance accordingly.
Right. So it's not about labeling yourself as a high risk or low risk investor. It's more about being aware of your current comfort level and adjusting your strategy accordingly.
Yeah, and it's important to remember that your risk tolerance isn't static.
Right.
It can change over time as your circumstances change, as your goals change, as your knowledge changes.
It's a constant evolution.
It is.
And Yang encourages viewers to do their own research, seek advice from trusted professionals,
Yeah.
and just never stop learning about personal finance.
It's a continuous journey of growth and adaptation.
I love that.
And that brings us to the end of our deep dive into Humphrey Yang's 10 crucial personal finance lessons.
It's been such a great conversation.
I know I always learn so much from these deep
Me
dives.
too. And we've covered so much ground today, from the power of delayed gratification to the importance of simplifying your investments,
Right.
tuning out that comparison game, and embracing the uniqueness of your own risk tolerance.
I think there's so many valuable takeaways here for our listeners.
And before we wrap up, I just want to reiterate one of Yang's most important messages.
Okay.
It's not about finding that one-size-fits-all solution. It's about empowering yourself to make informed choices
Yeah.
that align with your values and support your long-term goals.
It's about taking control of your financial future.
So well said. And remember, even small steps can lead to big results over time.
Absolutely. Start where you are,
Yeah,
take action, and never stop learning.
your future self will thank you for it.
And until our next deep dive,
Yes.
keep learning, keep growing.
And keep exploring this fascinating world of personal finance.
We'll be here to guide you along the way.
It's been a fascinating deep dive into Humphrey Yang's insights. What really stood out to you? Was there a particular lesson that kind of resonated with you personally?
It's funny. It's the thing that really struck me is how all of Yang's lessons, they kind of connect together.
Yeah.
Yeah. It's not just about following these isolated tips. It's more about adopting a mindset, a holistic mindset towards personal finance.
Totally.
And, take delayed gratification, for example.
Yep.
It's not just about resisting that impulse purchase, right?
Sure.
It's also about having the patience to see your investments grow over time.
Yeah.
The discipline to save consistently, and the wisdom to avoid that trap of comparison.
It's one positive habit, it kind of reinforces the other,
Exactly. Yeah.
leading to this more secure and fulfilling financial life.
It creates a positive feedback loop.
Yes.
And it all ties back to Gang's point about risk tolerance,
Yeah.
recognizing that your financial journey is unique, and what works for one person might not be the right fit for you.
So true. It's all about, like you said, understanding your own comfort level, your goals, and making choices that feel right for you.
Yeah, exactly. It's your journey.
It is.
You get to decide how you want to navigate it.
And I think that's such a powerful message to leave our listener with.
I agree.
It's not about finding that one-size-fits-all solution. It's about empowering yourself to make those informed choices and create a financial strategy that really reflects your own needs.
And your values. It's
Yeah.
like, what's important to you?
Exactly.
Because at the end of the day, personal finance is personal.
It is so personal.
It's about what matters to you and what you want to achieve in your life.
We hope this deep dive has provided you with some valuable insights and some practical tools to kind of navigate the world of personal finance
Yeah.
with a little more confidence and clarity.
And hopefully a little less stress.
Yes, exactly.
Because it doesn't have to be so overwhelming.
It really doesn't.
Once you break it down, it can actually be pretty simple.
It can be. And remember, even small steps can lead to big results over time.
Absolutely, yeah.
So what is one action that you can take today to put these lessons into practice?
Yeah, think about that for a second.
Maybe it's setting up a budget, automating your savings.
Or maybe it's picking up a book about investing.
Yes, or reading that blog post that we mentioned.
Yeah, there are so many resources out there.
There really are.
Don't be afraid to ask for help either.
Yes, there are financial advisors. There are,
Friends, family,
people who have been there.
people who've made the mistakes.
You don't have to.
Exactly. Whatever it is, just take that first step and keep moving forward.
Momentum is key.
It is.
Once you get started, it gets easier.
And remember, your future self will thank you for it.
So true.
So until our next deep dive,
Keep learning, keep growing.
and keep exploring this fascinating world of personal finance.
We'll be here to guide you along the way.
Thanks for joining us today,
It's been a pleasure.
and we'll see you next time.